So I'm going to walk you through the steps of the solution of assignment problem 14.1 regarding acquisition of control rules and more specifically the losses, what you are allowed or what can you recognize in terms of losses, and if you can't, how much you will be losing because of the acquisition of control rules. The first step when you get a question like this is to find out what is the acquisition date and to find out the taxable income for the deemed taxation year. In this case, acquisition date is on May 1st, 2012, which will give us a deemed taxation year from January 1st to April 30th, 2012, and the second taxation year will be from April 30th to December 31st, 2012. So let's see the first step, how to calculate the taxable income for the first deemed taxation year, for the first period. So in this process, we should be following the steps from Division B from Income Tax Act, computation of income. So the first one is a non-capital income, only positive amounts that could come. It's income that could come from non-capital sources like business, property, or any other non-capital sources. In this case, it's going to be nil, because if we look at the question, this company starts with a business loss, so it has no income. Under point B, we need to find out the net taxable capital gains. Now, from the question, we don't have any net taxable capital gains in this year, but we do need to look at the transfer of assets to the new company and see if we can have there any capital gain. So if I am looking at the land and then I am making the elections under the Income Tax Act and I choose the fair market value, then I'll get a capital gain of 82,000, which gives me a taxable capital gain of 41,000. If I go on and look at on the building, the next asset, this is a depreciable asset, and the fair market value, it's 380,000, and the cost of the asset was 325,000. So if I just do a small calculation there, I end up with a taxable capital gain of 27,500. Because this section will show me the net taxable capital gains, I need to see if I have any capital losses. And then the only loss that I can see in this question is from the temporary investments. So the loss is the difference between the cost and fair market value, and it's going to be allowable only half of it. So only half of it is going to be included in this calculation. If we add up all those three numbers, we end up with a total of this B section, subsection of 52,000. And if we add up A and B and C, it's going to be 52,000. If we move on D, we need to find out the net business loss. Now, if you look at this number, it is slightly different from the number that we started with in the question. In the question, it says business loss for the period from January 1st to April 30th, 2012. It's 46,000. Go aside and I try to go through this calculation with you. I'm going to start with 46,000, which is a business loss that is provided in the question. And then I'm going to make adjustments based on the assets that are transferred if I need to make any adjustments. If I look at the accounts receivable, the rule tells me that I need to write it off at the smallest value because I'm not allowed to create any reserve for doubtful accounts. So therefore we will be writing off the accounts receivable at the 76,000, which is the fair market value, and we need an adjustment for the difference with a value of 14,000. If we go back on building, on the asset that we have, on the depreciable assets that we have there, and we look at each asset individually for the building, analyzing, we look at the UCC, and UCC for the building, it is 300,000, and then the lesser of cost and fair market value, because this is a POD in this case, it's going to be 325, right? So 325,000, which will give me a negative 25,000, and this one is going to be recapture, added back, and it's going to be recapture CCA for the building. The same analysis, small analysis, we could do it for vehicles because we have similar case. The lesser of cost and the fair market value, it's going to be 132,000, and the UCC is 110,000, which gives us a recaptured CCA of 22,000. If we look at the equipment, the situation is slightly different because we have UCC of 60,000, and the lesser of fair market value and the cost is 45,000, which gives us a positive 15,000. A positive 15,000 will look like a terminal loss, but in this case it's going to be treated as a deemed CCA. It's the same treatment that applies for a terminal loss, but it's just called deemed CCA in this specific case, acquisition of controls. If we take the business loss at the beginning that was provided in the question and we add up all those adjustments, we end up with a business loss of 28,000 for the period ending April 30th, back in my Division B calculation. So under D, I have 28,000, and then the breakdown I just went through, which gives me a net income for tax purposes of 24,000. If you subtract 28,000 from 52,000, it gives you 24,000. Now, after I finished this part, which is Division B, I move on to Division C, where I have deductions available for corporations, and we have charitable donation, dividends, and losses. In this case, the only loss that I can use here is the net capital loss carry forward, but I am restricted and I need to deduct to the extent of a net taxable capital gains, which in this case is 52,000. Therefore, I'm going to have here 52,000 negative, giving me a taxable income nil. Find out how much in terms of net capital loss. Let's see how much I'm going to be losing because of the acquisition rules. So if I look in the question, I have a net capital loss carry forward from 2011 with a value of 96,000, and I can deduct this in the first deemed taxation year only 52,000. So the difference of 44,000, it's going to be lost. I have no choice, but I'm going to lose this 44,000. Once we have found out how much we lose in terms of net capital loss, let's look at the and let's analyze the situation. So we need to find out what is going to be the amount of a non-capital loss carry forward, because we don't know yet. So we take the business loss for the period, which is provided in our small calculation. Then we add up the net capital loss deducted, and we get a subtotal of 80,000. If we look at the income calculated previously under Income Tax Act, Section 3C, it's 52,000. And if we subtract from 82,000, it gives us a non-capital loss for the period ending at April 30th of 28,000. Now we have to look in the question again and see what are the non-capital losses carry forward from the previous years. And we have one from 2010 with a value of 123,000, and we have the second one, 87,000 from 2011. If we add up all those numbers, we get a non-capital loss carry forward at the end of the April with a value of 238,000. And we can still carry forward and we can still set off this non-capital loss in the future to the extent of a business income from the same type of business. So in this case, this business was providing cleaning services. So I have to make sure I have in the future income for the cleaning service business. So what's going to happen in the second taxation year from May 1st to December 31st in terms of non-capital loss carry forward. So the net income for tax purposes for this period is going to be 146,000 less 23,000. So if I look, my business in cleaning services is making a loss. So I can't set off any non-capital loss that I have founded in the previous step in this taxation year because I have a loss for the cleaning services. But if I move on in 2013 and I find out what is the net income for tax purposes, which is 263,000, the income from the cleaning services less 52,000, the loss that kitchen appliances has made, then I will be ending up with a possibility of deducting some of my non-capital loss carry forward. But I don't have room to deduct the full amount because my income it's 211,000 and my non-capital loss carry forward is 238,000. So I could deduct 211,000 and I'm still carrying on 27,000. And in the following year, when I'm going to get more income for the cleaning services, I'm going to be able to deduct the rest of it. So having this said, this was the last step from the question, and this is how you need to look at this kind of question.
Made with Doodlecast Pro.